All right, now to our next conversation. As electioneering activities kick off, let's look at how all of these activities will impact the banking sector. We have Damilola Olukman, our financial market analyst with Chapel Hill Denham, joining us right here on the show. Great to have you.
Yeah, thank you for having me, Ladi.
Yeah, so Damilola, we're expecting, inflation globally now is the talk of the town, and we've seen that, still inch up. But now we have, elections coming up. Spending is going to keep going up at this point. What can we expect with the inflation rate?
All right, thank you very much. My expectation for inflation, going into the month of May, is that we expect to see, the pressure, that started in March to filter into the month of May. That is, we expect to see higher headline inflation, for the month of May, which is broadly in line with, what has been playing out in the global scene, where we've had inflationary pressure, just spook developed markets, like the US, UK, and also the Eurozone as well. But then in our own case, rather than election-induced spending, the inflationary pressure, we've seen on the Nigerian front, has been largely driven by pressures, coming from the food side of things, and also pressure, coming from the core inflation basket, which is largely driven by the energy and the PMS price. The scarcity of PMS, alongside the energy-related issues, we've had so far. So for us, expectation is that May inflation, should print to the upside.
Yeah, well, that's the consensus, at this time. But how do you think, the CBN will respond to this? We're seeing the Fed, analysts are expecting the Fed meeting tomorrow. They're going to raise, some are calling for 75 basis points. Some are still saying about 0.50. But how do you think, Nigeria CBN will react to this, and how will it impact bank earnings?
All right, thank you very much. For us, in terms of how we think the CBN will react, we've seen the CBN, just take a proactive stance, to reining in on headline inflation, by raising the MPR rate, by 115 basis points to 13%. And, the expectation is that should moderate, the pressures, we've seen on inflation. Whilst we at Chapel Hill, we think inflation is largely driven by structural bottleneck. We see little or no pass-through of the higher MPR, on bringing down inflation. Nevertheless, at the next MPC meeting, we think the MPC might just adopt a wait-and-see approach, to allow for the 150 basis point hike in MPR, to allow for the impact, to be reviewed, going forward. Henceforth, we think they might hold rate, at the coming meeting. In terms of how this affects, bank earnings, it's pretty much a direct impact. The deposit rate, is typically an offshoot of what the monetary policy rate, is. And given that the MPC committee, had voted to raise interest rate higher, we expect to see banks, just book higher interest expense, which should pressure earnings, especially top-line earnings. And for us, we think the banks who are the receiving end, will be the Tier 2 bank, which have inferior retail deposits, compared to the Tier 1 banks, which have cheaper deposits in their books. So overall, we think the hiking, the inflationary pressures, which have given birth to the hike in MPR, is not without impact, and the banks might feel the impact in their earnings, come half year.
And Damilola, there are concerns that, the elections will trigger massive withdrawal of funds, from the banks. What do you think?
All right, thank you. There are concerns that the elections, would trigger massive withdrawals. I've also read some articles online, where people are postulating that this might be the case this year. But then if you look at the data historically, we haven't seen that play out, for most banks. What we've seen, over the last 2 years, is banks being aggressive, with their deposit mobilization. And in fact, the Q1 numbers that have been released, also show that banks have also shown this resilience, in growing their deposits, which has also filtered into loan growth as well. So whilst electioneering, might lead to movement of funds, we think bulk of these funds, will still find their way into the banking system, and we might not see the supposed sizable withdrawal of funds, affect the bank's ability to grow their loan books or to carry out their business.
What about loans? Do you see the scope for higher bank lending this period?
Yeah, definitely. I mean, coming into from 2021, down onto this period, we've seen banks, just resort to growing their loan book, as a means to shore up ends. You would recall that from, start of 2021, the banks failed to report sizable earnings from investment securities. So in a bid to shore up the tepid growth in investment securities, we've seen banks, just grow their loan book aggressively. And going into the election cycle as well, we think this trend will continue as aside growing interest income from loans, there isn't any catalyst, coming from other line items. And we, like I mentioned before, we think this trend will continue, not because it's an election cycle, but just because the banks are left with no choice, than to maximize, earnings coming from the loan side of things.
All right. What about impact on asset quality? What are your expectations there?
All right. Coincidentally, the last 2 election cycles, have pointed to asset quality issues. If you look at 2015, average non-performing loan ratio, was somewhat higher than the prior year, and that was the case in 2019 as well. Where we had the election. I wouldn't necessarily link that to election-related activities, as those periods have also coincided with periods where we had lower crude oil prices, we translated to pressures in the bank's loan book. So for coming into 2020, into 2022, we've also seen the banks grow their loan book aggressively, which would also mean that in terms of impairment charge, we might also see them report higher cost of risk, coming into 2022. And in terms of asset quality issues as well, we've seen banks, concentrate bulk of their loan book expansion, to the retail segment of their portfolio. And that segment of their portfolio, is highly susceptible to risk. So we might see slight uptick, in NPL ratios or slight deterioration in banks' loan book. But I don't think it would be as high as the alarming rate, we had at the last election cycle, in 2015 and maybe in 2019.
Think the upcoming elections will drive sell-offs across the Nigerian stock market?
Yes, proud to now, what we've had is during election cycles, we've had a massive repatriation of funds. But then the 2023 election cycle is a peculiar one, as it coincides with a period where foreign participation in our market is somewhat low. As at the last data release, foreign holdings of equities in Nigeria is only about 13%, which is a moderation from about 22%, which was where we closed 2021, and a significant decline, from 2015 and 2019 levels. So to that end, we might not see sizable sell-off, in our market, as this sell-off in the past, has been largely driven by the foreigners, just exiting the Nigerian stock market, due to election-related concerns. Given that the foreign holdings of Nigerian equity is somewhat low. We might not see sizable sell-off in the market. Rather, what we'll have is cautious positioning, in selective stocks, who are deemed fundamentally sound, and or stocks like maybe international breweries, the likes of Cadbury, who are towing the path of recovery. So we might not see general play in the market. Rather, we might see selective play across fundamentally sound stocks.
All right, but do you think it's time to go heavy on bank stocks? You think it's that time?
All right, thank you very much. For bank stocks, most of our banking sector companies, are trading at historical lows. When you look at the price to book, the valuation, appears very, very attractive. And when you look at the bank's response, to the competition coming from the fintech space, it has been somewhat impressive. So for us, we see pocket of opportunities, across fundamentally sound banks. In the banking space, our top picks, remains Access Bank with their large customer size, which could easily translate to higher earnings, for the banks. We also like GTCO as well, because when you look at the valuation of the bank, it's trading at below its 5-year average price to book. And we also like Zenith Bank as well, because the banks appears positioned, well positioned, to deliver strong earnings this year. So for us, we think it's a good time, to position in select banking names, especially the fundamentally sound ones. And we think the dividend yield opportunities, is also something to consider, as a plus to banking sector stock. Yes,
all right.
To your question, we think it's a good time to position.
Okay, so it's a good time to go heavy. All right, thank you so much, Damilola Olukoto, financial sector analyst with Chapel Hill Dedham. It was great having this conversation with you.